Good morning. Welcome to the BF Anderson Technical Report for November 21st. Trend following is all about understanding trend, and trend is critical. So you ignore the news, basically. You follow the trend. The market is a discounting mechanism. It's discounting the future. So let's get right into it. So far, the trend on the NASDAQ looks very positive. Uptrending moving averages, indexes hitting new highs. This really looks very positive. Same on the weekly. The weekly looks positive. We've got the 35-week moving average and a definite uptrend. On a weekly basis, things look very good. Now, on our new indicator, which is where we're comparing the NASDAQ to the consumer staples stocks. Now, this is basically technology compared to toothpaste. We can see that we're starting to see a little bit of a pullback in the ratio. However, that lower moving average has definitely turned up. Now down here, we have the XLK versus the XLP. Now this is a ratio. When the ratio goes up, it means that technology is strong. When the ratio goes down, it means that staples are strong. So we can see here, we pretty much broke out of a downtrend. The advanced decline line basically still in an uptrend, however, kind of rolling over a little bit in the last couple of days, probably due to the news on China. This is one indicator that's kind of a little bit of a yellow flag. It's not a red flag, it's a yellow flag. Now, yesterday we had 65 new lows. We're kind of seeing a period here where we're getting more new lows than I would like. However, it's not dramatic. On the long-term indicator, which is the 10-20, everything looks excellent. The moving averages are, we've got white space. Actually, the upper moving average is widening out. On a long-term basis, the market is definitely in a bull market, and it's a positive trend. Now, on the global Dow, we're seeing where it basically broke out above 3,100. Now, a really nice breakout at 3,200. Now, we're at 3,137, but things on the global side of the equation are improving. Now on the value line geometric, we continue to be somewhat stuck. It's not really breaking out above 540, 560. However, it is holding this support area. Now remember, this is an equally weighted index. On sentiment, we're starting to see you can see down here I have the put call ratio. We got into greed, really pretty much extreme greed. However, on the survey done by AAII, we're still in greed, but not extreme greed. This is a negative, by the way. We want fear. We want fear. Now, I wanted to take a minute and talk about a particular moving average that has really important historic implications. If you go back and study, going all the way back to like 1925, and you apply a 200-day moving average, let's say on the Dow, you're going to find that the 200-day moving average tends to get broken during bear markets. Now, for example, in the crash of '87, it actually came down to the 200-day and held, and then rallied from there. So what I've done here is I've taken the time period of 2008, 2009. You can see how the S&P 500 broke below the 200-day, 200-week moving average, and we really had a nasty bear market, and bad things happened. If you remember, in 08 and 09, the market lost over 50%. Now let's take another time period just to kind of get a feel for this. So you notice here the S&P failed to hold the 200-week moving average. This was a year of 2000, 2001, another dramatic bear market where the market went down over 40%. So you can see here, it broke the 200-week, went into a nasty downtrend. So let's look at where we are today. This is where we are right now. Now this is last year. This is kind of like that crash of '87 test where the index is in a very strong uptrend. We come down, we test the 200-week, and then we've rallied. Now if you kind of also notice here, the market really isn't that extended. I mean, we're broken out to new highs, but it's not like we're substantially higher. So we're just getting started on what could be a new leg up in the market. Now, another way to look at this is just one other way is I'm using a 11-month moving average versus a 13-month moving average. I've removed the index, and all I have here are those moving averages, the 11-month and the 13-month. We look for death crosses on this, and we look for golden crosses. Well, you can see here in 2008, which is comparing again to that terrible bear market that dropped 56%, you got a death cross here really in early '08, first quarter of '08, that really bad things started to happen. This is an indicator you should really pay attention to. Now, here's the same indicator, 11-month versus 13-month. This is 2000, 2001. We get the death cross, market dropped 49% in that time period. So if you're getting this kind of signal of trend, the market's telling you, bad things are coming. Now remember, difficult markets are followed by easy markets, and easy markets are followed by difficult markets. So where are we now? We're really in pretty darn good shape. This is the same moving averages, 11-month versus 13-month. We've actually gotten a golden cross. So we may be just at the beginnings of a new cycle. Now let's look at one more. This is the IBD 50 fund, which is 50 growth stocks. And then down here I have a small cap index, the S&P small cap. And you can see in both cases we're getting we're getting a golden cross on the moving averages, and then we're also on the small caps starting to see a breakout and a resumption of maybe an uptrend after having a downtrend in small caps. Small caps peaked in the summer of 18 and really have gone nowhere until recently. We're starting to see some action there. Now let's look at the top 5. These are stocks that are looking interesting. This is Advanced Micro Devices. This is semiconductors. You can see a very powerful uptrend. Stock looks good. This is Dexcom. Now what we're noticing, now we own this stock. I have to disclose that. Dexcom is in healthcare technology, and we're starting to see a rotation in this market out of enterprise software and computer technologies into healthcare technology. Dexcom is an example of that. This is a semiconductor called Qorvo. They're involved in 5G chips for the 5G networks. Stock is, gave a nice gap up. However, has formed a flag formation that's just not really getting going, but still looks promising. Seattle Genetics, here we have another healthcare technology. Stock made an all-time new high. It's been acting very well. Big volume came in here. We got the gap up buy signal, and this is what you call an ascending flag formation. And then Target. Target came out with earnings this week. You can see the dramatic jump in volume. Stock hits an all-time new high. So, with all the retail activity going on, Target seems to be an exception. So if you have any questions, please give me a call. Thank you very much.